Todd Briddell. How does the volatility we've been seeing in the equity market throughout the summer and through Labor Day actually affect what's going on in real estate?
Sure. I think in the U.S. you're seeing very little change in private equity real estate transactions. You're seeing a little bit of pickup in credit spreads, which may in the future in 2016 have an impact on cap rates, the way that people are pricing real estate. But for the most part, private real estate transactions are still very, very competitively priced. In the REIT space, however, I think this impact and this lift in volatility is beginning to get investment bankers pretty excited because of the impact on pricing that you've seen. REITs have traded off significantly during this time period. But overall, I think that the real estate market, in terms of commercial real estate market, is extraordinarily healthy, based on really the three things that we look at. If you look at fundamentals, supply, demand are really actually pretty excellent. If you look at the capital markets, a little bit of bump, obviously, with regard to credit spreads, a little bit of increased volatility in equity, obviously may lift prices in terms of, may lift cap rates, maybe depressing prices next year. And then if you look at the role of government, obviously there's a lot of questions about what might happen with the role of government in terms of monetary or fiscal policy in the future.
Well, you mentioned REIT performance, the IYR, which tracks publicly traded REITs. It's in the ETF, it's down about 10% so far this year. A lot of that is due to worries over when the Fed is going to hike rates. So why don't you talk about the impact of a rate hike on real estate and what that means to you?
Well, at CenterSquare, we manage pools of institutional and private capital invested in global REITs, including the U.S. The U.S. REIT market was up roughly about 30% last year. So I think some of the pullback that you've seen is really just a give back from last year's kind of outperformance. But what you're seeing more recently is this retrenchment, and it's a lot like the taper tantrum that took place 2+ years ago when the Fed first announced that there might be some pulling back in quantitative easing. Now that the Fed is on the verge of potentially increasing interest rates, I think it's got a lot of people panicking about what might happen in the future. And I think that theoretically, if interest rates go up, all financial assets, not just real estate, not just utilities, which have also traded down, should ultimately be re-rated or repriced. REITs in particular, I think, have been sold off because they were popular, because they've generated income. But the reality is that the smart investors put money in real estate because it's diversifying, because it does generate an income, and frankly, for the total return. So it's not just about the income. And if you look back historically, an increase at the short end of the curve really is less concerning, I think, for REITs than what might end up happening at the long end of the curve.
Well, another thing which caused market tumult this summer was the Chinese devaluation. So the dollar got stronger. How will that impact foreign buyers here in the U.S.? Because we saw Chinese buyers purchasing luxury properties here in New York. It was a big underpinning of the market here. So how will that affect real estate going forward?
The same thing's true in London, right? Where Chinese have basically come into London to buy high-end apartments in London. They're doing the same thing in New York City and San Francisco and other markets. If I were a Chinese investor, given what has happened in China this summer, and given the fact that basically more recently this small devaluation in the yuan probably precedes a larger devaluation in the future. If I was a smart Chinese investor, I would probably be looking to accelerate my non-yuan purchases and buying U.S. real estate and buying high-end real estate in London as well.
And then finally, you are a fan of investing in infrastructure, things like airports and toll roads. How do you do it?
Yeah, so what's happened in the listed market is that I think there's a very small number of investment managers, ourselves included, who are at the forefront of recognizing that infrastructure and real estate largely have the same type of economic characteristics. They have high durability, low obsolescence risk, just like real estate does. They've got visibility of cash flow and the ability to diversify an investor's portfolio. So the way that we do it is we buy publicly traded companies who own these large, enduring infrastructure assets. Like, for example, the Heathrow Airport or the Sydney Airport are owned partly by publicly traded companies. And we're getting is incredible low obsolescence risk with durability of cash flow, visibility of earnings, and diversification. So that's the way we do it. We construct a portfolio that owns 40 or 50 names around the world that own the best infrastructure assets. And the reality is there is just an enormous demand for that capital. And I think that the private market increasingly is going to be providing that capital because, frankly, the governments don't have the lending capacity or the borrowing capacity to do it.
Certainly a big barrier to entry there. Thanks a lot, Todd.
Thank you.
And thank you for watching The Street.